Warren Thomas, ExchangeRight. Thank you for joining us today. How are you doing?
Doing well. Thank you for the invitation.
You bet. You know, what I'd like to do, ExchangeRight has been such a fixture in the industry for so long, weathered a lot of industry ups and downs. You guys keep just staying the course, moving forward. Could you give me some background on the firm?
Yeah, a little bit on that. ExchangeRight, we formed it in 2012, and that followed my role in the industry really began in 2002 as a financial advisor, and I was actively involved in reviewing some 50 sponsors on the deals that they were bringing out to see whether they'd be suitable for my clients. And as the years went on, saw the need to create a more conservative product and one that was diversified, that utilized both no leverage and low leverage deals, because I understood to some degree, who our customers were going to be. And so we formed ExchangeRight in 2012 with this concept of being a diversified portfolio of net lease properties leased to investment grade companies. And by 2015, we were ranked as the third largest in the country, behind a couple of the previous players. So we came in at a time where the market was down, and we gained a foothold during that time period. And then since then, I've bought a little under 7 billion of properties, roughly 1,400 properties. And every year we end up being number 3 or 4 in the industry on volume. So that's where we came from. And also by background is I have 2 partners, and 2 of us are CPAs, so we come with a certain level of tax knowledge. And we now have grown the company. We've got about 150 employees, and we're managing all those properties, as 7 billion of properties that we have purchased over the years. That's in short how we got here.
That sounds like a great pedigree. Are you mostly mom and pop investors? Who is your avatar client?
Yeah, we started in the broker dealer channel, so and really the RIA channel, the Registered Investment Advisor channel, wasn't in this industry back in 2012 and the teen years for the most part. So that's where we began, and we've been servicing broker dealers. But that in the last 5 years, that's now expanded quite a lot into the RIA marketplace, and we're also expanding and servicing smaller family offices. So yeah, it's developed quite a bit. In 2019, we formed a REIT, which is a takeout vehicle for our 1031 DST products. And that's another market segment that the broker dealers and the RIAs bring cash into our REIT, as well as us going full cycle, taking properties or DSTs into the REIT.
Okay. And the REIT, as I understand it, you've got, I think, 3 different types of products or ways that you package the products. That's a voluntary REIT, isn't it? Or is it compulsory as far as doing a 721?
Yeah, it depends. So, in terms of products on our DSTs, we historically were creating DSTs that would have at least 3 exit options, meaning when we go full cycle on a DST, the investor could choose to cash out, or they could choose to do another 1031 of their choice, or they could choose to do a 721 into the REIT. So historically, we've always created both a levered and a non-levered DST to meet the needs of those individual investors, and then they would have those as their exit choices. On our non-levered, if they choose to go into the 721, and if interest rates are reasonable when we go full cycle, then the investor could also choose to do a partial cash out, because we can refi those assets put about a 20-25% loan on it, and then they could take cash out and roll the balance into the 721. So those are our two historical products. And then the third product, which now is 55% of all the money raised in the DST industry, is going into what you might term 721 only exits. Whereas our first two product choices, you could choose to go the 721. In this third version, it's a 721 only product. And again, the competition to us in this industry, if it's JLL or Ares or Hines, they've got 721 only. So we brought that product out for the first time in 2024, and it's getting great traction. So, we love that as a product option, but it's now one of the three DST options that we present to investors.
Okay. Regionally, are you invested all over the country? Are there some areas you prefer, some areas you won't touch? Where do you guys work?
Yeah, that's a great question. For the most part, we're trying to create a cash flow product. And when we're trying to create a cash flow product, if I can buy a Kroger in Ohio that's at a 6.25 cap, and if I'm talking to you from Pasadena, California, if I'm going to buy that Kroger grocery store in Pasadena, maybe it's a 4 cap. Well, because I'm trying to create a cash flow product, that 6.25 cap, that's more advantageous to creating cash flow than starting off by buying something at a 4 cap. Do I want to earn 40 grand off of my $1 million investment, or do I want to earn 60 grand or 65 grand? Well, because our average investor is in the DSTs is a 72-year-old, that they're a retiree, maybe they're a pre-retiree, but on average, they're looking for cash flow plus the tax deferral, plus safety principle and all of that. I'm going to try to buy in markets that where I can get a little bit higher cap rates. So the Midwest is an area I like. The South is an area I like. I might buy in California, but I have very few of my assets in California. We have 1,400 assets roughly that we have purchased since 2012, and we are in all 48 of the continental United States with those assets.
Okay.
So I will look at anywhere. I've got a very active acquisition team. We'll buy from individual sellers, from REITs, from sale leasebacks. We source from all over the place, and we're a pretty good buyer. So, brokers know us and want us to be on the list of their potential buyers. So I'll look at everything, but really, if you look at a heat map, you're going to see more concentration in the South. And, quite frankly, often they're more red states than blue states. So I don't want to get too political here, but at the same time, we're looking for ways or areas of the country where it's going to be good to be a landlord.
Well, and being able to limit that legislative risk, to be polite about it. We like red states too. There's some, looking at the portfolios and watching them over the years, you've got a handful of the big tenants that you like. Can you talk to that a little bit?
Yeah, sure can. So in terms of the tenant mix, I think across all of our portfolios, we have just under 90 tenants that qualify. And what's been a hallmark of what we do is I need to be buying properties that are tenanted by investment grade corporations or shadow investment grade. And what I mean by that is I want them to have a BBB rating and higher, because I want that default of that financial default risk to be extremely low. Because again, I'm servicing a retiree and a pre-retiree market. So when I get into that, and that's one criteria, and it's really important. On, of course, location, traffic count, crime count, demographics. that's all got to factor into every single purchase we make. But the credit is important. And then the asset type. I'm going to generally be in necessity retail, necessity healthcare, and distribution. So let me give you some examples of that. So if it's distribution, it may be that I am picking up a distribution facility for FedEx, right? They're going to be a high credit quality, and it's going to be a key location for them under a long-term lease. If it's in the healthcare, I might be buying BioLife Plasma Services or Quest Diagnostics or Fresenius. And some cases maybe a hospital, but they've got to have the credit behind it. And then in the retail side, I don't want big box retail. I want necessity retail. And the way that played out, like during COVID, when we looked at our asset mix during COVID, and the government comes up with this artificial definition or this phrase, essential businesses. Well, we were something like 96% of all of our purchases were classified as being essential under that definition. So what wasn't essential? Well, a Hobby Lobby wouldn't have been essential, and yet I would have owned Hobby Lobbies. And yes, even though they would have been closing or required to close, they're very strong balance sheets. So we never missed a payment, never a late payment. Another one would be Ross Dress for Less, rated above the triple Bs, had no issues with collecting because they were obligated. So you might say what we do is often essential businesses, but we call them, necessity retail, healthcare, and distribution. So that's what we do. I don't want big box. I'm looking for the creation of portfolios for our DSTs, not one single great big box, Costco that's really, really large. So I'm trying to be diversified.
With distribution, you're not really looking for the last mile distribution, or you are?
No, I'm looking for more of a regional distribution hub.
Okay, okay. As far as specific companies, I know you mentioned Fresenius. Do you get into drugstores at all?
If I was buying 10 years ago, I would have been buying Walgreens.
Yeah.
Today, of course, I'm not going to buy Walgreens. They got bought by Sycamore, so that's of no interest to me. But a good CVS, yeah, I'm interested. Matter of fact, I've got one in one of my most recent portfolios. So do I do drugstores? They've got to be, investment grade. And right now, CVS is the only one that I would look at, so I wouldn't look at Fred's, wouldn't look at some of these other varieties. They just don't carry the credit. From other retail that I am interested in, I've been a buyer of the dollar stores if they are Dollar Tree or Dollar General. Matter of fact, across our portfolios, I own many hundred of them, and of course, they tend to be small purchases. It might be $1.5 million to $3.5 million per store. Comparing that to a grocery store that might be a $15 million single purchase. But I'll have on the grocery side, I'll do Kroger's, I'll do Publix, I'll do ShopRights, I'll do Hy-Vee's. Again, they've got to be strong credit, but I like grocery. It tends to do well in recession.
Is Piggly Wiggly still around?
I don't buy them, so yeah, I don't buy them down south. Huh?
Tractor Supply, I think that's it.
Yeah, Tractor Supply. We're actually landlord of the year for their last year, so I buy a lot of Tractor Supply. I like them as a company, and we get a first look at a lot of their stuff, and that's an advantage of being landlord of the year. We're looking across the desk at their major players in their home office. When we go visit, we get attention. And that translates to often first looks at areas that they're developing or at sale leasebacks that they're considering. So that's really nice. It's also like Napa Auto Parts. We did a really nice sale lease back where they put new 20-year leases on 20 stores or so. And I could then buy those and splice them into my DSTs. So yeah, that's once I find a good tenant, I tend to, try to buy their top 25% of their locations over time, and that bodes well for everybody. So, yeah, that's kind of once you know a tenant, you know what their contracts are going to look like, you know what to look out for. You tend to know what their building construction is supposed to be. So it gives us an in, whereas the mom and pop investor, they might be looking at a dollar store or a CVS for the first time in their life, and they may not really understand what to look for inside of a lease or inside of easements, inside of other restrictions. And, it's helpful to do this all the time.
How big are your typical DSTs?
A typical DST is going to be somewhere in the 50 million to 100 million range.
Okay.
Something like that. They're not terribly big. I do the 3 series of DSTs, which I've already mentioned, that the one that goes right to the REIT after 2 years, and then the other 2 that have that exit optionality. And so I'm constantly buying assets to have inventory that is, 30 days, 60 days, 90 days, 120 days out. So we're in the market all the time buying and then creating, because I don't want to be without those 3 product types on my shelf always.
Okay. Have you, as far as how many states a typical DST might be in? I know I've run into that with a few clients, thinking, gee, I've only got 100 grand. Do I really want to file returns in that many states?
Yeah, that's a tough one. When we try to limit the all cash series to 2 or 3 states. If it's 721 or the all cash with the multiple exits, we try to limit those to 2 or 3 states. We get into the little bit larger portfolios that are levered, and I might have 8 states, 9 states, and maybe those 8 or 9 states have 2 or 3 that are tax free, like Florida, California, etc. But you need to look at that. The guy that's got 100,000. It may be immaterial to where they don't worry about filing the states, because the sponsors are not required to tell the states who the investors are. But you get to that level of $350,000 to $800,000 investment in a DST, and you definitely need to be looking at those states, because you're going to have enough income coming from a given state to where when you're sitting across from your CPA, they're going to probably be wanting to file because there's enough income to make it make sense.
Yeah.
We also find that when we get the $2 million, $4 million investor, they don't care.
Yeah.
They're going to file all the states anyway. Their accountants are used to it. It's typically the smaller investor that has more problems with the state filings.
That's what we've seen as well. Do you, since you're always in the market, you're always buying, you always have deal flow, do you do custom deals? If somebody comes along and just wants to buy an asset, will you work with somebody with a DST structure to
Yeah. So we have a custom exchange program as well, and we pretty much start that at a $10 million level.
Okay.
So if you got somebody that's got 10 million or above and they want to talk about custom exchanges, we'll consider it. But from month to month, we did 77 million a month ago, and last month was another good month it's made up of investors that are 500 grand, 2 million, 4 million. I know I've got a $14 million case closing today. But our bread and butter is the smaller investor.
Sure.
That's always in the market looking for something. So,
well, why don't we wind up with you regaling me about your track record? That's one thing I saw in your brochure. I was just like, man, you guys must print a lot, because you're continually having to update that track record, which is wonderful.
Yeah, if you saw our track record, we publish in our PPMs every deal we've done, whether it's gone full cycle or whether it's still in process of, where we haven't closed out the DST yet. And you might have seen probably 14, 15 pages of track record, which is offering after offering after offering. All of our offerings have met or exceeded initial cash flow projections. And I think we're the only one in the business that could say, hey, you've done 120 plus offerings and every one has met or exceeded cash flow projections. So yeah, it's a pretty stunning record, and it's indicative of starting with investment grade corporations that are leasing these buildings from us. So, and then if we've done our underwriting properly, then we're going to get a better than normal result on releasing when it's time to release. We're going to get a better than normal result because the location was better, maybe the sales on acquisition, the traffic counts, all of those things were better than most others because we're targeting a certain, a certain percentage there of what we're going to buy of their top locations. So, those two things have really made a difference. Now, in terms of full cycle, we have a lot of our programs that are in process. On the DSTs, we've gone full cycle on about 20, and next year we'll go full cycle on another 5 or 6. And then we're going to be going full cycle on 6 to 10 a year, probably each year for the next few years. So that's what we anticipate doing. And, we're looking forward to it. So sometimes that money recycles, and often that money ends up in your REIT, in the REIT.
Have you ever missed a distribution?
We have never missed a distribution.
In how many months?
Well, we formed in 2012, so we're in year 13.
Do the math. Yeah.
13 and a half years, never missed a distribution. But again, we've never had a missed payment of rent on any of our buildings in any program. So it's easy when you're buying subject to good long-term leases with good corporations.
Very good. I don't know if it's if we can even talk about it, Warren. Can you talk about what kind of returns you've gotten?
Yeah.
I just wanted to see what can you say.
Well, I'll speak from I'm going to speak from more cash flow returns.
Okay.
Let me go from there. So, when interest rates were down and we were getting interest rates on our levered programs of sometimes 3.2% for 10 years, the cash flows during that era, we'd lock those returns in for 10-year periods. And they might have started at 6 or 6.5 and then working their way up. So that was the history until about 4 years ago, when interest rates then, went from in the 3s or low 4s up to the low 6s. And when you look at a levered deal, then suddenly your levered deals, like today, if we look at our levered deals today, they are going to be starting at about 5%. On a product that's coming through the broker-dealer community, where, factoring in all costs and commissions that we're paying out and stuff. Our essential income series, we can generate, it's an all-cash series, and so it starts more like mid-5s. But historically, if we see interest rates dive again, come back down, then we'll adjust and we'll see cash flows going up. But we tend to lock in longer term interest rates when we bring out a new deal, because our investors want stability of income. They want to know what to expect. So I don't go to variable debt ever inside of these programs. I want it to be consistent. I want the result to be known. Now, then you look, the other side of that question is, what are your total returns? And I'll be quite frank, when I talk to investor about total returns, I will tell you, I think our DST programs are primarily cash flow programs, and not programs that you come into for the appreciation, because you're buying net lease assets and they might start at an average, 12, 15-year average lease term, and you're burning off years of the lease with every year that you're in the program. And in net lease, that diminishes value, and it's only offset by increasing rental rates. And the stronger your tenants, the flatter those increases are to your rental rates. So I look at our net lease programs as being really cash flow programs that are built for, security, your principal, but not really built for appreciation. In the first few years, yeah, we got nice appreciation out of our DSTs because cap rates were actually going down, meaning properties were getting more expensive as we were buying them. So that was good for the investor base. Now I see it as more of a flat cash flow oriented program.
Are you aggressive with the tax treatment? Do you do cost seg on most properties, or how does that work?
Yeah, that's a great question. We do not do cost seg, and the practical reason why we don't, if I start doing cost seg and I've got 10 or 15 properties in a portfolio, you might be getting 30 components of cost seg for every property. And then you've got 10 or 15 properties, you got 450 different cost seg items. This investor base doesn't want that.
Yeah.
So that's one reason. There's another practical reason is when you come out of a cost seg property and you're going to do another 1031, you've got to look for another cost seg property to go into. Otherwise, you might find yourself having to pay tax and not being able to do a 1031 on those components on the backside. So cost seg can sometimes be a tax trap. So I just, we don't do it more for the first reason I gave you. It's impractical when you've got so many properties in a portfolio. But there is a secondary reason why we wouldn't do it.
Oh, very good. So 25 has been a good year for you.
You know what? Every year's been a good year for us. So yeah, it's been a good year. Thank you.
Very good. Well, congratulations. And anything that we didn't cover you'd like to touch on or not?
Well, I would say, our REIT is an important part of our exit strategy. So we currently have 361 properties in our REIT. The 721 is an advantage for some investors. That we have that pool of investors that want to get to the REIT as quick as possible, because once in the REIT, you not only have theoretical risk mitigation from 361 locations instead of 8 or 10 locations into the DST. So you've got theoretical risk mitigation because of location risk, tenant risk, which is credit risk, lease rollover risk, refinancing risk. But then you also qualify for step up in basis like you would in a normal DST. You get that step up in basis. You also have quarterly valuations, so that's really good for estate planning if it's necessary. And then you've got quarterly liquidations available, whereas in a DST, you really can't liquidate until they go full cycle. So there are reasons why folks come into the REIT with going into the DST with the idea of going into the REIT. Those are the primary reasons. And then the REIT's very attractive for just cash capital with 60% or more sheltered by depreciation. So it's a nice vehicle just in and of itself.
Yeah, that's real good. How big is the REIT now? What's the value?
It's at about 1.3 billion, and it's 361 properties. It will be growing, but I got to be careful of forward-looking statements. So that's all I'll mention at this
That's
point.
all you can say. All right, very good. Well, Warren, this has been great. I appreciate you making the time, and we'll send this your way once we've edited and get your approval before anything goes out. So,
Okay.
all right.
Thank you very much. I appreciate the opportunity to get on with you.
You bet. Thank you.
Okay.
Bye-bye.